Good evening, everyone, and welcome to live strategy session Options Income Blueprint with Michael Schulman tonight on June 10th, 2014 here at 7:30 p.m. We're glad you could join us as members of Options Income Blueprint, and we're glad for a good evening here. Hope you brought your questions for Michael. He's ready to take them. Just a reminder here, this session will be recorded, so if you have to leave early or cut out, you can get the recording tomorrow. We'll send an email out letting you know that when it's available, as well as you can come back in and out of the session if you want to, but we're hoping you're going to get a lot out of it. Michael's always willing to take your questions. We will stay here as long as you need to get your questions answered. And with that, Michael, let me turn it over to you and get started. Thank you.
Dave. Thanks everybody for coming. I love these sessions. These are fun. I've picked up stock tips during these sessions from your questions, and most importantly, I discover what you're most either concerned about or most interested in. So I really do encourage you, if something occurs to you a couple hours after the session's closed, shoot me an email and so forth and so on. Let's get right to it. I have a brief couple of minutes and then it's just questions. The market, as you can see, has been reasonably kind the last month. That's the range here, it's a little hard to see, is 1860 to 1940, 1950 on the S&P 500. One of the questions I always get is why the S&P 500, not the Dow or the NASDAQ. The S&P 500 I find is more indicative of overall sentiment and movement because it includes more financial and banking stocks. The importance of this chart is not that we're riding a radical bull. I mean, the bull is very long in the tooth, but it will continue to be so, as you know, in my own opinion, from reading the update. The important thing here is to understand almost 50%, so between 46, maybe 48% of stocks are moving independent of the movement of the indexes. That means, translation, they're going to move up or down regardless of what the index does that day based on what people think of the stock. As a stock picker's market, it's great for us. It's not good for us. It's great for us. What this chart shows, and what the market has been providing us for a while, is we know there are no headwinds. The market is not necessarily providing a tailwind for a lousy stock, which we wouldn't be looking at anyway, but the market is not hitting us in the face and saying, we know you're a great company, we know you should be a great stock, but we're not letting you go up. That doesn't exist in the market, and that will continue to stay that way. As I said, I rarely spend a lot of time writing about the market, but in the update from last week, not this week, I wrote about, does this market have legs? And it clearly does. It has the lowest amount of participation of investment in equities. I mean, the amount of money people have saved for investment purposes. But depending on how you measure it, it's the lowest rate since the 1950s as a percentage of equities. You have a Fed committed to low interest rates even after employment improves more than it has. You have the European Central Bank now charging negative interest rates, meaning if you're a central bank of, let's say, France, or a regular bank, you have to pay them money to hold your funds because they want them to lend. The central banks of the world are much more concerned about deflation than inflation, and this is all buoying the market, and it certainly has eliminated headwinds. Again, if you've been reading me over the last few weeks, and we'll get into specific names later, when you ask your questions, I'll refer back to this. The 4 areas that I'm looking at for the summer are energy, with a specific focus on fracking, but energy and fracking, I consider them somewhat different. The New American Consumer, which we really could rename the top 20%. Consumer spending in the United States is now being driven by the 20% highest income earners. It used to be the top 35, and now it's the top 20. They're spending between 55 and 65% of all consumer discretionary income. Selected medical products, I've always followed them. I can't remember not following them. And they don't necessarily fit into any worldview that I have, except that you have more patients because of the more Affordable Care Act, so you have more use of products. I don't like regulated medical companies like insurance companies and certain providers, so I stay away from them. And this is iPhone summer. It's very important that you aware there's a lot of energy building up around a belief that the new iPhone is going to energize what are really great Apple sales. People just don't think they're great because you have to badmouth the rising market. You have to badmouth a great company to be able to get on CNBC and get your free coffee. And the bottom line here is this is iPhone summer. and there's a lot of peripheral companies involved, and that there's a lot of enthusiasm coming up around the iPhone. So these are the 4 different things you can expect me to write about, and you can see names fitting into this. There's always going to be another name, but these are the 4 areas where most of the picks that you'll be seeing will come from. So that's it. This is really your night. We'll talk about positions. We'll talk about tactics. We'll talk about portfolio management. I know many of you from your emails are interested in that. We'll talk about specific companies of the market, whatever you want to talk about. One comment about logistics, because of a couple of questions that came up. I can always tell when someone is relatively new, a member is relatively new, from an email that customer service has forwarded to me, either for me to answer or if it's something they just want me to be aware. Someone asked about the timing of alerts and so forth and so on. Let me recap for those of you who are unfamiliar with this. Almost all alerts come out between 10 o'clock and 2 o'clock. And alerts can come out Monday through Friday. I have no memory of recommending a new position on a Friday. I do send out reminder alerts on Fridays. You know, we've sold a weekly, it's going to expire worthless. Just thought I'd remind you in case you wanted to spend a couple of pennies and close it. If we have to roll a position and it's a weekly, we have to buy it back and sell another one for the next week. That'll typically come out on a Friday. If it's something that's a monthly that we have to roll, it might come out that week. It might not necessarily come out as late as Friday. And I never know how many we're going to do. There are weeks where just the market or the names that I follow, I have a bullpen of 25 companies, a lot of them I own. Personally, in my portfolio, I have another list of approximately 50 companies that I like the company, or they haven't made the cut for the final 25, but I go into it depending upon trading conditions. So trading conditions for a specific week or a specific 2 weeks or a set of days will often determine the environment that I feel comfortable in making a recommendation to sell a put or sell a call. So the bottom line is, can't tell you how many are going to come out. I try to remember if I'm sure 2 weeklies, for example, will be coming out. I try to put in the first alert saying there's probably another weekly position that will be recommended this week. And that's about the limit that I'll commit myself, because I don't want you holding back on your capital. I know this may make it a little bit more difficult. You have to choose, where am I going to put my money, where am I going to put my capital, but that's just the way you have to do it. That's the way you have to trade these kind of things. There's no really more practical way to do it. So that's the comment on logistics, the boring stuff. So I look forward to your questions, and I shoot away, Dave. Ask me away.
Do you want to get up your screen ready also?
Oh, I'm sorry. Yeah.
Then we'll start the questions.
That would be useful to call up a website with screens. Here we go. Let me know if you have it.
We got it.
Okay. This is the chart you just saw. This is the 30-day chart of the S&P 500. I put up the chart of the SPY, which is the exchange traded fund for the S&P 500, because these bars on the left tell you the amount of volume that are flowing in of people buying the ETF or selling it. And you can see a lot of volume came in around the 1950 level. It's people anticipating 2000. People coming in and selling and buying around 1950, or they're realizing 1900 is now a foundation and a base, and then there are people saying, no, it's not going to break 2000, so they picked 1950 as a place to sort of duke it out the last few days. Thanks for reminding me, Dave.
Okay, here's a goodie. We know people are going to be asking this. Was CRE? What's your perspective on CRE right now?
Let's call it up. Sure. Let's call it up. And I'll explain to you a little bit about the company, and which is actually very important, because this is a fundamental pick. It's one of the bullpen stocks that I like very, very much. These bars, as you can see, you have enormous amount of support, a real foundation coming in at 45. You're going to hit some headwinds up here, a little bit above 50. This is sort of, I know you real technical guys, you're into moving averages, you're into deltas or whatever. We're doing enough shorter term positions, week to 6 weeks. Volume, to my mind, is much more important. Now, I look at moving averages when I'm doing monthlies and all sort of the typical technical indicators. But just to remind all of you, I start with a great company. I look at the stock, and from the stock, I look at the applicability of the options to the tactics that we use to generate income. Now, with CRE, let me do all 3 things. The company has made a massive move into retail. CRE owns an enormous amount of intellectual property, related to LEDs, and its major product push in the last 3 to 4 years has been light bulbs, and within the last 2 to 3 years, the big product push within that has been consumer light bulbs for your home, for an office, or what have you. And approximately a year, I'm guessing maybe a little less than a year ago, maybe half a year ago, I saw their first ever end cap, one of those end of the aisle things that they have at retail stores. I saw it in Home Depot, and it was for Cree, and it was actually a regional sales type talking about it, and they had broken the $10 price point for an LED light bulb. That's a big deal. And I saw their first television ads for their LED light bulbs. What this is doing is they're using their bulk to create a market for LED light bulbs and making them aware that they're much better than the fake, the fluorescent, whatever their CFL bulbs, which I personally don't care for. And the LEDs are significantly superior technology. They last longer. There's a whole bunch of reasons to spend the extra money. And what has happened is their revenue has really climbed wonderfully, but Wall Street did not anticipate their margin compression, meaning the reduction in operating margins that they have. Well, it makes sense. They've reduced prices because of mass production, allows them to, and they're spending money on advertising and, of course, future research and development. So over here, when they announced earnings, they really were pretty good. But the street wanted to see them expand revenues, which they knew they could do by going mass market retail, but expected them to maintain margins, which is like, you know, I want to put the slipper on Cinderella, even though she has a size 17 foot. You know, it's not. It doesn't work. And you know, it's a quasi-momentum stock, and traders got out of it. That break creates a buying opportunity. I own the shares, and I've sold calls against them. So what do we do with Cree? If you take a look at the chain, and the stock right now is 47.10. So about 8 trading days from now, the 47.50 put is a circuit. You can see how rich the premiums are in this. And I'm not recommending, by the way, you sell it in the money put. Don't get me wrong. But you can see that the difference between 47.50 and 47.10 is 40 cents. Okay? So the last trade here was $1.15. Let's take that 40 cents away from the $1.15 and say that the amount of money that people are betting that the stock will go below 47.50, or if you sold it, the amount that you're believing that the stock will stay above it, is $1.15 minus 40 cents, which is 75 cents. Well, doing simple math, let's say it's 2 weeks, that means you could do this 25 times in a year. Well, 25 times 75 cents is about 18 bucks. It's actually $18.75. Well, if you divide that into 47, it's a huge rate of return. That's about a 40% annualized rate of return. You don't need to do the math with me. My point is that this is a very volatile stock. It's hugely liquid. It is an ideal trading vehicle to sell puts or to own. I own shares and sell calls. I know many of you were put shares or opted to buy shares. For those of you who weren't in that trade, I recommended, it might have been a weekly, it was probably a monthly, and we closed the position before earnings came out because I didn't want to have you in the position during the earnings announcement. And some of you didn't do that, and the stock blew up. And we were out, but many of you were still in. So I follow it, I like it, I own it, and it's stable now. And because it's been stable for this period of time, well, you'll probably be seeing me writing puts against it, or even doing a buy right. And for those of you unfamiliar with the term, it would mean a buy right would be you buy the shares today at $47.10, and you turn around, and this is 7 days from now, or let's say you did it for this week. Let's see what the price would be for this week. So you turn around and you sell the $47.50 for 30 cents. If you're not called out, fine. What you could do is you could buy it and sell a 47 if you really want to make sure you are called out, and you get 50 cents for that. So you have a 40-cent profit in 3 days. While 40 cents doesn't sound like a lot, that's about a 45 or 50% annualized return. So there are different ways you can play this. It's one of my 25 bullpen stocks. I love the company. I very much like the stock. You saw the chart where it's holding. And you can see the premiums here are still very, very rich, so it's a very, very good trading vehicle. And, you know, so that said, don't be surprised if you see some sort of an alert, you know, sometime in the near future recommending we put on a position on Cree.
Okay, Michael, everybody knows you like the energy sector. David asks, please comment on the anti-fracking movement erupting in Colorado.
Um, oh, you really have the people in Boulder versus the people in the northwest corner of the state that want to secede, either from the state, from the country, perhaps from the planet, based on some of their literature. Um, I don't have any energy plays on my horizon that are, that are linked to development of that shale formation in Colorado. It's not really germane. There are some small master limited partnerships. Some of them are probably publicly held that own properties and are developing it. I'd like to extend the question to what is the national issue about fracking. Just by way of background, when Dick Cheney was Dick Cheney was vice president, he had been running Halliburton, an oil services firm, beforehand, and in 2003, it might have been 2004, I think it was 2003, there were amendments passed to the Clean Air and the Clean Water Act that prohibited the Clean Air and the Clean Water Act from being used to regulate oil and gas extraction. Well, that means that under that statutory and regulatory authority, the EPA does not have the right to regulate oil and gas extraction. It does have the right to promote transparency in anything, on a voluntary basis, and it has the right to regulate fracking when it comes to drinking water. However, the administration's attitude, forget what you hear in the news, you have to look at the facts. Last week or 10 days ago, the administration issued, the EPA, on behalf of the administration, issued guidelines requiring a 30% reduction in carbon, much of which already been met. In the Northeast, that goal was already met and surpassed, and they have new goals. To do that, you have to frack. And the administration said to hit these goals, most states or some states have to burn more natural gas, and we're going to get it from fracking. It was an explicit endorsement of the need for fracking to reduce global climate change. No one's writing about it because the business publications just want to say everything the administration does is anti-business and anti-energy, which of course is nobody's pro or con everything all the time. And the bottom line is the federal government has a focus on the transparency of what chemicals we're putting in the water. Fracking is an issue, going back to the original question, state by state. It's on hold in New York because Cuomo's running for governor, and if Hillary Clinton doesn't run, he may run for president, and he wants the environmentalists on his side. And just south of the New York border in the Marcellus Shale is 40,000 people or more currently employed in fracking in northern Pennsylvania. So it's sort of going on everywhere, and it's unstoppable, barring a gigantic accident, which is hard to see it happening because these aren't gigantic, huge fields. There's a lot of activity, but they're no one big, gigantic well. And fracking is here to stay, and it's a 25-year minimum, maybe 3 times longer than that. By that time, we may not even need natural gas. Who knows? And it's a major, major, major event that is still being underestimated in terms of its impact on the United States economy. And there was just a piece in there are some German newspapers that are translated to English, and a couple of German GASF has moved all its new operations to the United States because gas is $12 to $14 an MC a 1,000 cubic feet in Europe, and it's $4 here. And they use it as a feedstock, and they go out of business if they can't get $4 gas. So fracking is here to stay, and to the extent that you own or are looking at investing in, or you're going to do a position on that I recommend related to fracking, you don't really need to worry at the national level about anything untoward happening towards the industry.
Okay, Michael, we also get a couple questions on Gilead. Do you think Gilead will recover quickly, or would we need to hold longer?
I answered 7 emails to the same friend today, and this is worth a long answer. Well, I like giving long answers anyway. A friend of mine.
Can you call up Gilead?
What?
Call up Gilead on the chart.
Oh, I'm sorry. I apologize.
Chart, yeah.
Everybody
see the
Gilead closes 79.54. Let me call up. Oops. Call up the chart, and let's do the last month. And here's what happened here. For those of you unfamiliar with it, Merck bought Idenix, a smaller biopharma company with a hepatitis C treatment, perceived perceived as a competitor to Sovaldi, which is Gilead's hepatitis C treatment. Let's step back a second. I followed Gilead since 2002, and I've been saying since about 2003 that it's the best biopharma company and therefore the best drug company on the planet. For the last 7 or 8 years, they're the only company gaining market share in HIV and AIDS treatments. They have an extremely powerful set of products that are extremely successful and vital to human health. And they have relationships with every liver specialist, keep that in mind, every endocrinologist treating advanced liver disease, because that's one of the primary things that are hit when you have HIV and has to be monitored in the world. And their drugs are sold in every developed country, and they have discounted older drugs that are sold in emerging markets that can't afford the full price. They bought a company. The company had Sovaldi. That's the name of the drug. It's a hepatitis C treatment, but unlike every other hepatitis C treatment on the market, it cures. So 90% of the patients in clinical trials saw complete ending of the hepatitis C disease. It's a gigantic breakthrough. Hep C is all over the world, and despite the headlines, and just like you may get one set of headlines about improper regulations in Washington in one set of publications, you're going to get another set of headlines and another set of publications about how cruel and unfair the $100,000 price is for Sovaldi. Gilead's not going to budge. That price is staying where it's at. And the bottom line is insurers don't like paying it, but they're not denying. Of course, guess which agency said we're going to maybe look at this and put it on hold? The VA, of course. But private insurers are paying it, and the reason is very simple. Over time, to treat somebody and cure them in a 6-week to 12-week period is a lot cheaper than giving them drugs for life. That's the first thing. The second thing is under the Affordable Care Act, you cannot turn down someone applying for insurance who has hepatitis C. Third, occasionally you've got to pay for a liver transplant. That's $250,000 just to start, plus all the follow-up treatment and therapies. And not all insurance companies and providers are totally 100% willing to let people die or be sick. And the bottom line in this is very good medicine. So that's the backdrop. Sales come out, they're unreal. Fastest growing drug in recorded history in terms of billions of sales in their first 12 weeks. So Idenix has a competing drug, supposedly. And the bottom line is what people are ignoring, because this is a very headline-driven stock for about the past 90 days because of the complaints from some idiots in Congress about the expense of the drug, and traders are involved, is Gilead has a follow-on drug that is already in front of the FDA that should get approval, can't promise it, but should get approval by December, that eliminates the need. Right now when you take Sovaldi, you take interferon as well. It eliminates the need for you to take interferon. It puts it 2 to 3 years ahead of competitors, and there's no proof that Idenix's drug will be approved or will be as effective. The other thing that people are forgetting is Gilead, as I said, owns the relationship with liver specialists, hepatologists. Once specialists in any field, cancer, diabetes, what have you, come up with what is known as a treatment protocol that works, they don't change. They're not going to change from Sovaldi to something else unless that something else is 1/10 the cost, which it won't be. It'll come out at the same price or maybe a nickel less. The other thing that people are forgetting, and this is even more interesting, is that once the new drug comes out, that's the combo drug, it eliminates the need for interferon, it will become what is known within the medical profession as the standard of care. When you run a clinical trial for a new drug, the ethics of the medical industry, the healthcare industry in the United States, is you have to provide standard of care first. There are fewer side effects, noticeably fewer side effects when you're not using interferon. Sovaldi will become the accepted standard of care in many treatment centers, which means they can't run clinical trials, which means coming up with a competitive drug is going to be increasingly difficult. The bottom line is I think the stock is worth between $120 and $140 a share. I think they're going to blow out sales and earnings for the next 4 to 8 quarters, and that this is all noise. It is noise. I don't believe in conspiracies of short sellers, so it's not short sellers, but it's a bunch of very uninformed idiots on complaining about cost and a bunch of traders moving in and out of the stock because they have no understanding that Gilead isn't a pizza company and that it's a biopharma company. So I own it. I sell calls against it. I will occasionally load up and get another block and write calls against it. Sometimes I sell puts. I love the company. I think it's in great shape. Short term, okay, we'll go to 5 days. It dropped here on a headline because I can't remember. Oh, it was the acquisition. It was Merck's planned acquisition of Idenix, as if this is going to change the way Joan Smith, hepatologist, is going to treat her next patient after 100 of her patients have successfully been cured with Sovaldi. This is just a short-term reaction that creates a buying opportunity and the ability, if you own it, to sell a call, or if you don't, to sell a put.
Okay. Michael, this is a question we have without going into immense detail, but somebody is asking more about the double dividend idea. Christopher's asking about the idea of selling calls on stocks like Annaly or Verizon when they're about ready to go ex-dividend. Just give a.
Well, I want to show you something else. I own this, by the way. Seadrill has a 10.8% yield and went ex-dividend yesterday. Whoops! You can take a look what happened right here. Okay, it dropped. The dividend was $1, and Seadrill dropped a little more than $1. Okay. Now let's look at what happened to the calls or the puts. But let's take a look. Excuse me. If you own the shares, let's say you had sold the $39 call. It got cut in half today. So the double dividend trade is a call trade. And what you would have done in this situation is you would have bought Seadrill shares, you would have sold calls that were high enough away from the current share price that you didn't stand a good chance of being called out before it went ex-dividend and you didn't get your dollar. And then that dividend then the stock sells off the value of the dividend, or a little bit less or a little bit more, and the call gets cut in half and you buy it back. And here's the reason I went to Seadrill as an example. With the big mortgage REITs, which would be AGNC, or Annaly Capital. Let's look at Annaly. This trade is over. Everybody knows it. And I'll show you why. You'll see where do you see the numbers? Take a look at the number of contracts that are standing. People have done the math down to the 4 parts to the right side of the decimal place, and there's very, very little weight. Take a look at the premiums here. I mean, this is June. It's 3 cents. It's because they know it's stable, they know when the dividend dates, all that sort of things. With the very big REITs that are well known with very high yield, you can't do the double dividend trade anymore. You can do it on Seadrill, which I do in my own portfolio. You can also do it on companies with more modest dividends like Verizon. Verizon has about a 4.5% yield. It's a fabulous company, by the way, much better than people know because they think it's a big old-fashioned telephone company. And if you take a look, you get these spikes up and down. These are headlines too. What's T-Mobile doing? What's Sprint doing? The stock's really worth about $58 or $60. And when it goes ex-dividend, it'll drop, then it comes right back up again. You can do the same thing of selling the call and watching it drop. Now your timing has to be pretty good. It usually has to be between 2 and 6 weeks before expiration, and you have to keep an eye on it, and you might get called out. And the way to do the math is take a look at your purchase price for the shares. You sell a call. If you can, try to sell a call that if you were called out, the appreciation of the shares, because you're selling it at a higher price, and the amount of money that you have in the premium from selling the call, those two things combined, are greater than the dividend that you lose if you're called out. That's a good rule of thumb. There's a handful of stocks that double dividend is a good trade. Most of them are the lower yielding dividend stocks, between 4 and 6 or 4 and 7%. Seadrill's a good one to do this against. And if you shoot me an email, I'll dig up a list of some of the other ones that you might want to take a look at. I'm off because you also have to understand sometimes the calls don't come down in value, meaning sometimes the stocks don't move. The stocks don't move that much after it goes ex-dividend. So you also have to pick ones where you have the opportunity to either watch the calls expire worthless or buy the calls back.
Follow up on it. There's a couple questions. We have one on Google this week. If you were, how do you look at Google trading at around 560? Is that a good put selling option this week or next week?
It might be. They don't have any catalysts coming up. I mean, earnings are not coming up. I don't think. I can check. Actually, while I'm talking, I'm going to go check to see when their next earnings announcement is. I don't know if you're seeing my screen.
Yep.
Are you seeing me get out of the chart?
Yep.
Okay, good. Okay, let's go check and see when earnings are. That'll give us. You always have to be aware of external events. Earnings are July 17th, and so what you have here is a fabulous company. I mean, it's a great company. I know people who work there. It's a great company. They actually have, more market share in Europe than they do here, which is why the Europeans are picking on them and making them do things that no other search engine has to do. And let's take a look at 1 month trading, and you can see here that the stock has moved, and you can see there's a lot of volume here. If you want to look short term, which was the question, was because I was going to look at the moving averages, you can see right at here at the 560 level is a lot of action. That at 560, this is stalled. Now, I can go to another chart. I'm going to go to, I like the Yahoo. Yahoo does a very cool chart that I like. So I'm going to go over there. And we're going to just do a basic chart. And we're going to do 5 days, and we're going to compare it to the NASDAQ. See, and this is one of the issues with Google when you're doing a short-term trade. Google is sensitive because it sort of pulls the index pulls it. So you can see they're going to, spike up. This is Google right here in blue. But shorter term, that's a month. A short-term trade, if there's a sell-off in the NASDAQ, it'll take the stock down. And the stock will bounce back, but in the short term. Now, the bigger reason you never see it, okay, and I'm going to call up the chains, where I've never recommended a put against Google. Well, initially, is there were no mini options on it, and no one, it would be inappropriate to recommend a $500 stock. What happened to my chain? That's interesting. Google mini options. Wow. Anyway, weird. But that's strange. Anyway, it's not important. They have minis, and the minis allow you to do 10 shares and not 100. So the capital requirement here, for example, would be 56. It would be 5,600, not 56,000. If you're looking to see, going back to the question of why, let's say the stock's at 560. You can see here the 560 put for June week 2 is $3. That's a very low premium. It's not a lot of money. And that's the reason you haven't seen Google in Options Income Blueprint. For whatever reason, other mega caps like Apple have significantly higher volatility and have significantly higher premiums. This may be worth the money. If you do $3, you do it 50 times a year, it's $150. But it's $150 into a $5,600 investment. It's just not. It's not a really good use of your capital. Does it mean I don't like the company? No, I love the company, and I'm hoping to get a tour actually of their campus in the first week of August. But the bottom line is you have to match the stock to the availability of premium to sell puts or calls against, and that's why you haven't seen it in Options Income Blueprint to date.
Okay, Michael, we had a couple email questions ahead of this session asked about Apple, since it's a stock that was very expensive price-wise, not necessarily the stock, but now has split. And what do you think about Apple now that it's split?
Well, I'm writing an article on it right now as we speak, so I may wax poetic for a couple of minutes on this. Apple was down for 12 or 18 months because it wasn't growing 40% a year, and everybody thought Tim Cook was not Steve Jobs. Well, he's not Steve Jobs, but there's a reality here about Apple. Apple invented the portable music player, the solid-state portable music player linked to a music system, the iPod. They invented the better smartphone, the iPhone. They truly invented the tablet that worked, the iPad. They have a PC 3 times as expensive as their competition, and they're the only personal computer company in the world picking up market share, even though it's in a non-consumer market, the non-laptop market, it's small overall. The bottom line from a product point of view, it is as good as it has ever been. It has seen its market share shrink because of Android/Samsung. And the company, and this is what the street hates, and I don't really care. I don't own the stock anymore. I may be getting back into it. I'll tell you why in a moment. Is Apple will not sacrifice margins for market share, and this drives people crazy. Well, Samsung's a Korean company, which means it will always sacrifice margins for market share. Google is just doing the operating system, and and Chrome, and they could care less because it's what they probably spend on paper clips. It's not a big deal for Google, either on the revenue side or on the cost side. So Apple's primary competitors have two different business models, and that has eroded their market share, but they still have a huge one. But it hasn't changed some reality. The reality is going to be revisited this summer, and this is the point I'm getting to. They have a series of product launches that are rumored for this summer. One is the iPhone 6, which supposedly will have a much bigger screen, 4.5-inch screen. There are always rumors about an Apple Watch. I think these thing about watches, people are going to sell 7 of them. I have no empathy for anybody who wants to use the product. I don't understand why people think it's been great. And the bottom line is the big push in the company is going to be to figure out the final penetration of the home and media, which will be the television. And the question is whether it's an Apple TV or whether it's a small device that hooks into your TV. This will be the biggest Apple product cycle in a long time. Apple always trades on product. This big run-up here that you see on screen is due to the stock split. Forget all the other rumors and all analyst recommendations. This is about the stock split, the share buyback, and the dividend increase. It's about nothing else. In the middle of this spike, you began to hear the rumors about better product, and Apple always trades on products. And here's my opinion about what to do with this. Apple is selling at a multiple less than the S&P 500. I want you to think about that. It has, I can have some fun here. That's briefing.com. I think it has 150 billion in cash. Some ridiculous number. Let's see what it has in cash. It has 18 and 7. Long-term investments. It probably has about $160 billion in cash. It is an unspeakably cheap company given the quality of its brand. It was just surpassed this year by Google as what was the #1 brand in the world in terms of the power of its brand, which is measured by a market research firm, several. And Google is now 1 and they're #2. They both replaced Coca-Cola. And the bottom line here is, as a long-term holding, this company will eventually catch up with the S&P 500 and will eventually surpass it. And it also has very nice premiums. They're not great, but they're good. So if you bought the stock, for example, and it's all messed up because the stock split, trying to get a clean price is pretty hard. But if you bought this at $94.29, which is essentially the current price, it doesn't seem like you're going to make a lot of money. You're going to make 60-something cents, okay? But you can see the volume here, and that's also because of the split. Well, 65 cents times 50, okay, times 50, you can do this 50 times a year, is $32.50, which is a more than 35% annualized rate of return. So, if you want to be clever, you could, buy it here and sell something in the money and guaranteed you get called out of it if you don't want to own it. It's the same thing as a put. Or you could just sell a put here if you agree with me and you like it, and you could sell. This put has a lot more than the call, so you could sell the $94.29 and you could get this amount of money. But this is a trade. If you sell the puts here, you really want to own the shares. I mean, we're at a point where there's going to be a lot of emotional resistance to the $95 to $100 price point. New option strikes are being created in future months. A lot of retail investors, a lot of mutual fund investors. Don't kid yourself. They're not great technicians. I'm not a great technician. But I understand what I don't understand, and the bottom line is there are a lot of emotional price points. Take a look. Look at the volume here at 95, which is this is a brand new one. Meaning, because the way the stock split is, you can tell that this position's only been open a couple of days. 35,000 contracts traded hands today. So there's a real emotional overhang that is not going to move the stock until the product announcements, which are anticipated for August. I don't expect, unless the market really runs, I don't expect Apple to be able to cleanly clear the $100 barrier until the product announcements come out. And then the next overhang will be, well, how well did they do? There'll be a lot of pent-up demand for the iPhone, and what you have to do long-term is assume or believe that the company will eventually go back to where it should be, which is it's more valuable than most S&P 500 companies and will trade at a multiple higher than the average in the S&P 500. That puts it at maybe between $125 and $140 a share, maybe the next 1 to 3 years at least.
Okay, back to energy. Les wants to know, are there any coal plays in the option income selling area?
Short them. I wouldn't go near a coal company if it was the last company on earth. And I mean, I can't state this strongly, that you may have a contrarian view. The coal companies have been hit hard because of fracking and shale, and the Chinese economy someday will rebound. I mean, there's 10,000 companies with options in the United States. Don't go anywhere near a coal company, please. I mean, great stock symbol, BTU, but when I had a short newsletter, we started shorting this, I think it's 70. I can't remember. I mean, take a look at this. There's just, there's some core residual value, but in this country, starting with and it didn't start with what the EPA said last week, it started a couple of years ago. The EPA, for those of you unaware, last week put in these goals that the states have to meet in their own way, which is a very flexible approach, to reduce carbon emissions by 30%. But a couple of years ago, the EPA put in new smokestack regulations. There's no existing technology that exists that can be used to clean coal that it would have to be cleaned to. I mean, you could build a power plant doing oil or gas and meet the emission standard. You can't do it with coal. So it's dead. And I can't urge you enough not to go anywhere near these. It's dead money. I don't see any reason. The Chinese economy is one big bubble that the government is going to have to slowly deflate. They won't allow a crash to happen. And coal utilization and electric utilization in China, they've not plateaued, but they're getting close because of the pollution issues. They'll be switching more to oil, et cetera, et cetera. This is not something you want to go near.
Okay, we have a question, another stock here from Stephen, Enterprise Products Partners. That's EPD, Echo Papa Delta.
I'm not really familiar with it. I've seen it before, and it's a small services company. Yes, it's a midstream energy services company, and if I remember correctly, they may have had a different name. Yeah, they have a decent dividend. I followed these I looked at it about a year and a half ago. I'm not particularly familiar. That's a nice chart. I'm not particularly familiar with it. I feel a little uncomfortable talking about it. On the other hand, that's a heck of a chart. And let's take a look at this. This is the kind of scouting you need to do. When you're on your own and you like a company, you're going, oh, should I buy the stock? I'm only going to buy the stock if I can sell calls. I don't want to buy the stock. Maybe I'll sell a put and I'll get a cheaper price. Let's take a look at what people think of it. This is a medium volume. You can see 524 open interest contracts, and you're looking here at a $55 to $75 put for June. That's about a 20 to 25% annualized return if you could get the 75%. Which is very nice. If you got 55, it would still be about 17% annualized return, and that's a good price. So then what you really have to ask yourself is, you go to briefing.com and see when earnings are. Is that volatility because earnings are coming up? No. So that volatility and those premiums are based on the way that the stock has been trading. So I just wrote a note to myself to take a look at it, and if there's anything there, I'll write about it in the update on Monday.
Okay, Michael, another stock we have some interest in is Stratasys, SSYS.
SSYS, I am not familiar with this company, but let's see what it does. I always hope when I'm not familiar with something, it's been renamed, so I actually know it and lost it. Oh, it's a 3D printing company.
Yeah.
Ah, which means it must have a PE of about 6,000. Nope, doesn't earn any money. It doesn't earn any money. We don't trade it here. I went to one of the benefits of living in Washington is you actually get access to some really smart people who give free speeches. And I went to the National Chamber of Commerce, and there was a whole thing on advanced manufacturing and 3D printing. It's a very, very exciting field. And actually, let's go back to them and take a look at what their revenues are. It's a very exciting field, especially if people are, to my mind, doing it properly. Whoops, must be a foreign company. Where are they based?
Minnesota.
Oh, foreign country. It's right there where my kid goes to school. He's graduating in 3 days. I couldn't resist. And you're taking a look at huge, absolutely huge revenue growth. If they're experiencing this kind of revenue growth, and they're losing money, although just in the last quarter, it means that they've obviously carved out, and I was reading the profile, they've carved out a niche in terms of making, what would be an example? I'll give a perfect example. An oil field in Alaska, it's a true story. They have 3D printers because it's cheaper for them for the extreme expense of using a 3D printer to print out certain kinds of parts, especially certain kinds of seals that they had specifically designed to work on a 3D printer, rather than have them flown in case something, or carrying spares that are very expensive in inventory. This is a great market. It is not a good market. It is a fabulous market. On the other hand, these are momentum stocks. They don't have a lot of earnings. Well, this company has huge revenues, but not a lot of earnings. So you have to take a look. You know, there's the summary. You can see there's no E&P, but let's take a look at the the premiums. So you go to a June, the stock's at 91 and June 90. Well, 2 weeks from now, you're looking. that's a 100% potential annualized return. I have to see if their earnings are coming up. I can't resist. Let me see. EPD. When are their earnings?
Wait, SSYS, I thought you were talking.
Oh, it's SSYS. I'm sorry. Apologize. SSYS. Their earnings are in August. So this is just a clear momentum stock. It looks like a solid company. I don't know a great deal about it. I'm going to take a look at it. I'm very intrigued because those are wonderful, wonderful, wonderful premiums. Now, in many ways, GTAT, which you obviously read about today, GTAT is a mature company that's in a brand new market, which is sapphire glass, which is going to be used in the next generation of iPhones. It's a publicly known fact. They have a contract with Apple. They're doing the manufacturing of the glass in Arizona. It's being shipped to Asia for the companies assembling the iPhones. In many ways, there's a parallel here because there's an existing business that is yet to turn profitable, but the company we just left the screen clearly is doing things other than 3D printing. There's no way they're doing $500 million in just 3D printers. So finding companies that make the pivot, that make the turn, and end up being profitable, you get two things that are really terrific, which is a solid company with real revenues and a real business, plus all the sexiness. I worked for a public relations firm that said every press release had to have sex and hot dogs in it. When a story of a company becomes a sexy story, it's 3D printing, you get a lot of trading in the stock, which creates the volatility that we like when we're selling calls or selling puts. So I'm grateful to whoever asked the question, and I'll be taking a very serious look at this starting tomorrow because it seems to be that hybrid of an extant mature company that's in a new technology area that's really putting the stock, on everybody's radar.
Okay. Jim asked about, Michael, your opinion on U.S. Steel and the recent price action.
Well, the recent price action is it's bouncing around 24, and this is the last 10 days. It sort of doesn't want to leave. Get above 24. Doesn't want to go too far below 24. This is this I think was the day they announced the layoffs. Two small plant closings, which were also designed to get dumping duties put on, which will take a couple of years. And you can see 24 is where this stock is going to hover around 24. I like the company very much. I own a position in it. I've sold calls against the position. And if you take a look, I mean, it's been hammered. And this is an indirect to a quasi-direct. Well, let me get longer here. Sorry. This is an indirect to a quasi-direct play on fracking because the amount of tubular steel that it sells to shale extraction firms and for pipelines. And this over here was going down because of some fundamental numbers, and plus, I think mistakenly, the Federal Trade Commission said that the Koreans were not dumping specialty tubular steel into the U.S. market. Of course they are. Just let's not go there. But it was it's being dumped, and there's nothing that can be done about it. So price competition is a concern, and that hit the stock. But as you can see, when we go back to the short term, it likes it over here for now. So this is a good place. I'm not saying it's going to break 24 anytime soon, but in the short term, for shorter term positions, it's a good place to be. It's a good place to sell calls. It has very nice premiums. It's a good place to sell puts, either one.
Okay, Michael. I know we don't have any call trades open right now, but we had a couple people asking, both in the email, asking any ideas on some decent call trades in the next couple weeks.
Sure. Well, the problem with call trades in Options Income Blueprint is I can't read people's mind as to what they own. And it's a mea culpa. I mean, I've never been able to figure it out. And not that I'm a mind reader, but figuring out, the 5 most popular stocks just doesn't work. If you go to the website, you'll see there's a bunch of stocks there that are you might think are core holdings. They're sort of almost leftovers from buy rights that were very successful. Otherwise, that stock wouldn't be there. And I don't write many calls against them. I figure people are pretty much on their own. And but it's a fair point. Now, it's an open-ended question. When you sell a call, in theory, if this was a textbook, if it's well managed, a series of calls and owning a good stock, great stock, is going to be more profitable than selling a put. Always, because you have two things going for you. You have the sale of a call, and you have the underlying appreciation of the shares, while when you're selling a put, all you have is the cash coming in from selling a put. Now, if you sell a stream of calls against a name, against a stock like U.S. Steel, if U.S. Steel, let's say you sold at $24.50 and it goes to 25 and you get called out, you're going to lose some of the profit. So I'm not suggesting you're going to get 100% of the profit from the underlying appreciating asset, but you're going to get a chunk of it, as well as all the cash you're going to get from selling calls. So in my own portfolio, which is reasonable size, I'm much more into owning shares than selling calls, even day trade calls. But the bottom line here is, if you're looking for calls to sell, what you're really asking is, what's a stock that you think is not going to go up in the next 2 weeks? And it's sort of like I have to look at the stuff I don't like, meaning the call recommendations that I would make would be buy rights where I suggest you're going to be called out. Okay? So let me give you an example. I'm going to use this as an example. I'm not necessarily making this as a recommendation. But let's say you bought tomorrow morning, let's say this was where it was. Let's say this was 10 to 4 this afternoon, and you bought this for $23.85. Okay? And let's say you sold the 23, not the 24. You sold the $23 call because you wanted to be called out. You did not want to own the shares. And it's the same thing as buying a put. Well, what you're going to make in a week and that's July. I thought they looked kind of rich. Let's go to June. It's $1.03. Okay? So that's not a good trade. So let's go back to July then. So you sell the 23, and you would lose 85 cents. You'd make about 15.47. You make about 62 cents per share on the trade in a period of 5 weeks. It's 5 weeks, a little over 5 weeks. Let's say you do it 10 times a year. It's about $6. That's about a 25 to 30% annualized return. It's a very good trade. Now, when you do that kind of a buy right position, it's because you don't want to own the shares. Otherwise, you would buy the shares and you'd sell the 24. And over here, the 24, you're getting 90 cents. That's a huge premium. This, that's like $9 if you do this 10 times a year. That's a 37.5% return. That's a really, really, really good trade. Like this is the kind of trade, if I was going to put more buy rights into the service, and I do it occasionally, anecdotally, this would be one I would consider doing because I really like the stock. In terms of stocks that are good, big, liquid stocks, I like Bank of America as a stock to own and to sell calls against. They used to have, I got skunked. I was expecting to see a 1550, a 16, and a 1650. So you could a week and a half from now, you could get 14 cents, which doesn't seem a lot, but assume you sell a bunch of contracts, not just one. Let's say you get called out. Let's say hypothetically you bought this at 15.92, you sold the 16, and you get called out. Someone wants the shares at 16 a week and a half from now. You have your 14 cents here. You have an 8-cent profit. That's 22 cents. Oh, Schulman, why do you want to do something for 22 cents? Well, you do it 25 times a year. It's a 2-week time period, so we use 25 as the multiplier. And 25 times 22 is about a little over $5, $5.50. Well, $5.50, and you divide that into the capital you spent, that's about a 37, 40% return. It's a great trade. So I like Bank of America. I came prepared. I like Ford. I love Ford. This is a $22 stock, posing as a $17 stock. And here, you can get 18 to 20 cents just free money. You get called out, you bought the shares at 17, you're selling this, you're getting 20 cents, and it's all done in a week and a half. That's the equivalent of getting $5 over the course of a year on $17 investment. I like Ford. I like Corning. The only problem with Corning is when the iPhone announcements come out in August, if Gorilla Glass is not part of them, the stock will take a hit. And people have pretty much absorbed that Corning's Gorilla Glass is not being phased out, but is a lesser part of the component mix at Apple. And a lot of Corning still trades based on on television sales. But this is also a very, very good stock to buy and to go ahead and trade against. Maybe they'd be kind enough to have 50-cent increments for their. Nope. Oh, yes, they do. I thought they did. So here you can buy the stock at $21.50. No, this isn't as good as Bank of America or Ford. And if you want to go up the food chain, there are some other companies. I like Williams-Sonoma here. Again, I like. That's a July. Let's go to June. These are not weeklies. This is a monthly. Williams-Sonoma has. Well, that's June. I want July. You can see that it's not super rich, but it's an undervalued company. You buy the 67.50. There's a whole bunch of them. I've listed the stock. When I list those stocks in the update to watch that I may be writing about, it means I like them right now. You can go back to the update from yesterday and take a look. I like GTAT. Obviously, I put it out. Let me call my bullpen list up for short term. And I own a bunch of these, so I'll tell you what I do. I like Tesoro right here. It came down today. And it trades in a pretty narrow range between 55 and 57. It doesn't seem to be able to break 57.50. Very, very rich premiums. For those of you who are familiar with it, it's a refiner in the Pacific Northwest. The big deal here for Tesoro, I mean really big deal, is right now 50,000 barrels a day of their capacity is using fracked oil. Next year, 325,000. What's the difference? It's higher quality, but far lower transportation costs. It will potentially expand their average operating margin. That's not net profit, but the average operating margin, which is how Wall Street values refiners, it'll increase between $3 and $6 a barrel overall because of what's going on there. So it's a great long-term play. It's very volatile. This is the kind of position, for example, if you want to do something, you might want to sell. If you agree with me, you might, like right now, you could sell. That's a good trade. You could sell the $55. You may see this tomorrow as a monthly. This is a wonderful return. You're getting 1% flat out, roughly 1% here for a 7-day trade. Let's see what the June is. The June 55.50. Very nice trade. And if you put these shares, you turn around obviously and you sell calls. Tesoro is another one that I like very much. I like GTAT. And again, you can always feel free. I mean, we could. I don't want to, read out a whole giant list here. Shoot me an email. I love my emails. I love giving, more specifics. One last one that I really like, and again, I own it, and that's Blackstone. This is a $44 stock posing as a $33 stock. Blackstone, for those of you who are familiar with it, is a private equity firm that's publicly held. It's a giant money manager. They just spun out Hilton, but kept the money in the company so Hilton can build lots of hotels that it's going to own and not franchise. Just did the same thing with La Quinta Motor Inns. It is the largest residential homeowner in the United States. They bought an enormous number of homes. I think it's a couple 100,000 during the crash, and they're slowly monetizing these. They have episodic dividends. They're not predictable, but they are on average year by year going up. The next one's at the end of July, and this stock is probably good right up to here. Let's look at the short-term chart. As I said, I own it. It struggles a little bit up here, so it's actually pretty good to sell calls against to own it. Fundamentally, it's considered the best in class as a private equity firm, and you can see what the chart looks like over a period of time. And you're going to see here a lot of resistance, so that's one of the reasons that it popped to mind is, you can see there's a limited window here. You probably could sell calls and not get called out. And if you bought it tomorrow at 33.64, and let's say you sold the June. So let's say you sold the June 34. You're going to get 41 cents. You're going to make a 36-cent profit, $34 minus 33.64. So you have a 36-cent profit, and you're going to add that here at 77 cents. Multiply that again. We do the 25 thing. 25 times a year you could do this. Excuse me. That's about $18, $19 on a $34 investment. So that's maybe the sweetest trade that we've looked at in answer to that question. If you're going to buy shares and you're going to sell calls, and again, I do this with Blackstone in my own portfolio, that's the best one we looked at in the last 10 minutes.
Okay, I'm going to get the name right. Santilal here has a question. He has two stocks, and I'm sure we're going to have heard these before. Green Mountain Coffee and Micron Technology, GMCR.
Well, let me answer MU first. Micron is MU. I have never, I really don't like Micron, and that's me, okay? Let me call up the chart on Micron first. I'll explain why in a moment. It's not because of how the stock's been behaving or anything. All the semis are hot, by the way. This is the year-long chart, and you can see that if I told you that I didn't like it here and it's up here, you'd be walking my neighborhood looking to knock on my door and hit me with a baseball bat. This is a, big giant gain. But if you take a look at Micron, that's from the crash. Where's the 10-year chart? There we go. I followed it even before this because of a former life doing a lot of work in semiconductors. The reason I don't like Micron is I find it hard to understand their business. And I find it hard to understand their finances. So I'm admitting that I have a bias against the company because I can't figure them out. They originally had a lease on life because the Justice, and this is not exaggeration, this is many years ago, the Justice Department would not allow Intel to have 100% of the microprocessor market for personal computers. So Micron lived off of 15% market share, and every time Intel announced a new chip, Micron would take a giant hit because their sales went down and they had to go spend money to develop a copy. That's not what they do necessarily anymore, and they have a lot of other businesses, and I've lost touch with them. Let me call up and see how they're doing on the earnings side. They have a very reasonable P, but here's the best part, as long as I'm in this chart. Oh, maybe I don't need that. I'm trying to call up the Philadelphia Semiconductor. There we go. So let's go here. Whoops. Sorry. Am I still on screen?
Yeah.
Okay. Okay, this is the Philadelphia Semiconductor Index, and this is one of the reasons MU is so hot. This is classic coming out of a recession. This is classic explosion in mobile devices. Mobile devices use a lot of chips. They're little ones, but they use a lot of flash memory. They use a lot of small circuits. Your your refrigerator now has something probably from Sierra Wireless. So that you see the two charts are completely similar. Within semiconductors, as you know, like SanDisk. I prefer SanDisk to almost any other company because you don't have to pick a winning anything. With SanDisk, they're in everybody's tablet, they're in everybody's phone. I mean, you know, and we started trading in Options Income Blueprint. Well, we started trading 3 years ago, so let's see where it was. Yeah, we started, you know, right around here, and it's gone up. So Micron, I've given you a long answer to say I'm not liking it out of not understanding them as opposed to there's anything wrong with them. So I'm sort of punting. Now GMCR, Green Mountain Coffee Roasters, has an interesting chart and a very interesting profit picture. You like this? Look at this. You really want to try to sell a put on a stock like this? I'm sorry, I'm laughing. It's one of those stocks that momentum traders still can't get enough of. The PE used to be over 100. It's very reasonable now, and I'm looking at their income statement now because I haven't looked. I follow them. I not follow them super closely, but you can see that they are increasing. So their real P's, their forward P's, probably in the low 20s. The reason traders love them, and one of the reasons people probably just ask the question, is there's always been superb premiums on the shares, always. And here you're looking at doing, you know, if you sold a put, you know, you're looking at 3% or 2.5% a week. So you can see, you know, why people like it. I'm not familiar enough with the company's recent trading. It went off my list a long time ago because of its volatility, and I don't think I'd ever put you guys into a company with a chart like this. Take a look at this. I mean, you could get stuck in this for 6 months if it goes the wrong way, and you know, it has all these huge premiums, but it is subject to three things. It's subject to its own earnings. It's subject to whether Starbucks catches cold and decides to crush a competitor, and it's subject to coffee prices. And bean prices went up, they're coming down again, they're going back up again. Bean prices often are good for Starbucks and worse for smaller companies. So I stay away from it because I don't know if you took the training program, there's a recommended range over the long haul for implied volatility for selling a put or selling a call, and when the volatility gets too high, I don't think you should get into a position because it's just too hard to manage, and that's the case with Green Mountain Coffee Roasters. Now, their business is pretty good, don't get me wrong. I just think it's too difficult a stock to manage in the specific strategy that we're pursuing here. Not if you have a different way of approaching stocks. I'm not suggesting that it's not a stock you couldn't figure out how to own on your own, but for what we do here, it doesn't work.
Okay, we're getting down to the last couple questions. Michael, JP Morgan, JPM at 60 right now. What do you see for that? I got a couple people asking about that.
Well, there were some people who would put the shares from our position. I mean, it wasn't that we didn't get out of it, but the let's take a look. Last time I looked, we were, yeah, that's what I thought. What you see, it's filling this gap, and let me call up the 10-day. No, that's not working. Let me go back to 6 months. There we go. When we're here, about 57, when this gap has been filled for a week or two, it'll be time to write calls if you own it, and it'll be time to write puts if you don't. It needs to show momentum that it can stay there. JP Morgan had a problem with earnings, and they're going to have another problem with earnings. Don't get me wrong. The bank's trading revenue, fixed income trading, bond trading, has just fallen like a rock. And all the great trading, the Merrill Lynch, which is part of Bank of America, and JPM, they're all hurting in terms of what people's expectations were. Now, those expectations have been ratcheted down by Wall Street. And that's one of the reasons the stock has been going up, because the other parts of the business are in pretty good shape, and the investment banking business is picking up because of mergers and acquisitions. So what you're looking at, if we can stay here between 57.50 and 60, right? The gap here started around 57.50. We fill this for 5 or 10 trading days. Then, you know, my own mind, it's been filled, and they're building a new base, and that's the time to start doing something. If you own it, I wouldn't necessarily sell a call right now because I have a feeling the stock's going to keep going. This tells me that it's plateauing a tiny bit, but it's still got some room to run. And I think it's probably, a lot of people are talking about filling the gap the way I am, and it's probably going to be pretty, it could move to 60 in the next few days, which means it would be pretty good to sell a put. But I'm a more conservative guy than you might imagine. I want to see it fill that gap for another few days before I'd make a recommendation. On a fundamental basis, it's a pretty good bank. It's too big. It needs to be broken up. It needs to get rid of some of its piece parts. Remember, if it didn't have Jamie Dimon's reputation from the crash and Jamie Dimon's reputation on the street, this stock would have been devastated by the series of trading mistakes that have happened in the bank over the last 3 years. It's basically his name that has kept credibility, that has kept the bank having credibility with investors. If he was a Vikram Pandit or someone else who didn't have that kind of hard-nosed reputation of being able to fix things, stock would be in a lot worse shape than it is now. And he's staying with the company. I'm not suggesting he's leaving. So give it a few days, and then after a few days, if it holds around here, it's in really good shape.
Okay. Mark asks, any opinion on the gold or silver positions like we've taken before? I guess the GLD, the
Sure.
SLV.
Oh, you sound like an old timer, someone who's been around. Okay, look at that chart. Let's look at this one. Let me actually, this is something that I haven't discussed because I've been discussing the positive side, which is what is going on in the market that I see is pretty positive. I can tell by emails. Emails basically give me the temperature of members. And it's anecdotal, but in the past it's been pretty accurate over a period of time. Because, and I'm not being as cynical as you might imagine, because the market watches and the Wall Street journals and everybody of the world needs to have click-throughs. And because the market's been pretty much going on an unrelenting pace since 2008. Okay, that's the GLD. Everyone's calling for a correction, and I made fun of it. Well, why does it have to have a correction? Well, it has to, right? Well, there's a corollary to that attitude, which is we have to have inflation someday. Why? Because the Fed has created so much. Well, they say the Fed's printed money. The Fed doesn't print money. It creates liquidity and borrowing power. And so we have to have it. Why? And they said because that's the way it's always been. First of all, it's not the way it's always been. The gold trade and the silver trade, its cousin, come from two things. Oh, excuse me. They come from a fear of inflation, which grabbed people because of the amount of liquidity created by central banks and because all the people who were in the inflation trade were reading textbooks written in the 1930s. And if I'm showing disrespect, I mean to. The second reason is there was a lot of geopolitical uncertainty. We had people in Congress willing to renege on our national debt and then shut the government down. We had bus drivers in Greece burning buses and knocking our market down, the Dow 500 points, because Greece was crashing and Portugal was crashing and Ireland had crashed. There was enormous amounts of there was a legitimate uncertainty about what was going to happen in Europe. And, you know, just the whiff of a problem about you're not going to pay the national debt could scare some people, so people fled to precious metals. Perfectly understandable in the context of the market and the psychology market. Of course, it has no basis in rationality. Gold is worth no more than dirt. It's only a matter of perception. Silver actually has a real value as a material in electronics and medical devices. The bottom line here is we're in a period of deflation, and the Fed is going to continue to keep interest rates low. There is no empirical proof that the liquidity that the Fed has created will even remotely stir up inflation. And what I mean is the Fed has created liquidity. It has saved the banks. It's found its way into assets like bonds and equities. It has not found its way into the consumer's pocket. Inflation comes not from the creation of money. Inflation comes from the creation of buying power at a rate faster than the ability of an economy to produce the goods and services to be purchased with that new buying power. Well, China can manufacture anything, and just give them, they'll steal some more land from a village and ruin another lake, and they'll build a factory. So there's no problem in worldwide ability to create. There was on the commodity level, metals and whatever, because it takes time to develop new mines. And there are spot shortages anywhere in a small industry. But the bottom line is there's no inability of the world to meet demand. And I know people talk about Chinese credit and this credit and central bank credit, but essentially consumer purchasing power around the world is still less than it was 6 years ago, because of radical cutbacks in credit. And if you put it all together, there's no inflation. And that's why gold and silver in this chart looks like the way it is. The inflation trade is dead. And geopolitical uncertainty, I mean, think about it. The Russians basically invaded Ukraine and took some of their property, the territory, didn't budge. So this is not something you should put your money into right now, unless you have a 20-year time horizon. But you have to understand, gold, adjusted for inflation, is selling for less than it did in 1980. And you don't believe me, go check it out. So it's a very poor trade, and we will put it on. And the fellow who asked the question may have been with us in the summer of 2011. My God, did we make money? And it was because of the geopolitical uncertainty. We could sell puts on inverse ETFs and on gold and silver monthlies. We close them 2 or 3 days later and make 3%, 4%, 5% in 2 or 3 days. And if we ever get a correction related to geopolitical events or the Fed, we'll do it again. But gold and silver are not good. And there are some undervalued companies, by the way, in the sector. Here's Newmont Mining, and here's a long-term chart. And you can take a look. And it's a very fine company. Okay, it's a very, very fine company. In fact, let's see what their trailing dividend is. Yeah, trailing dividend. Oh, yeah. Well, they used to have a real dividend. And this is a very solid company with very, very good assets. But the last wave of run-up in gold prices, they opened up a whole new generation of mines that had higher costs. So their overall operating margins went down. So you could, if you wanted to play gold, you might want to take a look at a miner like Newmont Mining, because they have pretty good. They used to have pretty good. I don't follow them that closely. Yeah, they have very good premiums. So if you go to July and you look at the $22, that's pretty good. That's a 20% rate of return, maybe a little bit less, on a put that's well out of the money. So if you're going to do gold, I would take a look at the quality miners, which are really Barrick Gold and Newmont Mining are the two that come to mind. The ETFs themselves don't have enough premium if you're going to sell options. And look at those two miners. Barrick Gold is ABX, is the symbol. And, oh my. And well, that's an ugly chart. I mean, yeah, that's much worse than Newmont. And those are the two companies that have sort of flattened out and have figured out. I mean, these are well-managed companies, and despite the chart and the problems in their business. But from a trading point of view, if you think that gold is going to come back or silver has come back, logic says they will not for a considerable period of time, because I can't figure out how the world can have inflation. And I don't care what people say, screaming and yelling on television. They're just out of touch. We live in a deflationary world, not an inflationary world.
Okay, Michael, here's a question. I think we'll end on this. Last question here, and you can do a wrap-up. Joan asked about trading during the week of July 4th. 4th is on Friday. Sure. So there's two parts to the question. What kind of trades would you put out that week? And what does a short week like that, this would be good for everybody anyway, short week like that do to our trading in options?
Sure. John, thank you for asking that. That was one of the advanced questions. John, and I meant to discuss it when I called up logistics before. That's going to be a light trading week as well, but it doesn't mean we won't trade. There's some. It doesn't really matter with some stocks. There'll be trades put on, and those options will expire on a Thursday, and you'll start seeing light trading starting about 10 o'clock in the morning on Thursday. So what we will probably do is I may recommend there's a bunch of weeklies that open up the week before, and you saw that on the screens tonight. I might do weeklies for that week, the previous Friday, or that Monday. Or if the trading environment is rough, we'll take a pass. It really all depends. That also is the week that I like doing monthlies. I like doing monthlies about 2 to 3 weeks before expiration. So it's also possible, if there's a concentration of trades, if I do 2 or 3 trades that week, you'll see 2 monthlies and a weekly, maybe even 3 monthlies. But typically, 2 to 3 weeks before expiration is when you get a really nice balance of monthly, of premium versus exposure to the market. The flip side is right after July the 4th, we enter earnings season. So I have to be fairly circumspect in taking a look at which companies will have earnings that come out after July expiration, which is what I would try to do. But it's a good question. I just made a note to myself. I'll remind people about this when I write the update towards the end of June and let people know exactly, sort of tactically, what they can expect when. In terms of wrapping up, I appreciate your questions. I like to talk about stocks, as you might guess, and we're doing a lot of short-term trading, with 2-3 days, 5 days, 3 weeks. But the way I like to describe what we do here is we think and discover like investors, and we generate income by trading our investment beliefs and ideas. And what that means is whether you've been with me forever or whether you're brand new, it does start with the stock and the stories I told tonight. This wasn't just to fill up airtime. If you're going to sell a put and you stand the possibility of being put the shares, I know most of you don't want to own the shares. You don't want anything to do with them. But I can't put out a put recommendation unless I believe in the stock and I believe in the company, because it might happen that you put the shares. So please be aware if you're hesitating on a trade. I've looked at the company and the stock. I do nothing. The charts are the last thing, and I know I drive technicians nuts because I don't look at anything they look for a 2 to 3 day trade. The stuff they look at is not worth it. Monthlies, it's a little different. You'll see that if you take the training program. So the bottom line that I want to leave you with is this is a stock-specific way to view the world. Ask me questions about stocks by email. We're in a great, this is, some people would argue, the best market for stock picking in 25 years in terms of the way stocks are moving independent of the NASDAQ, the S&P 500, and the Dow. And do not be overly concerned about a correction. You get a lot of emails about corrections. Personally, I don't see one coming, but the way the market has been trading is, barring a geopolitical or other exogenous event to the market, great stocks will continue to go up. So the bottom line in all of this is we're in a really ripe environment. It's a time to commit. If you're dabbling, dabble harder. If you're shooting for 12% a year, have a glass of wine and tell yourself, I'm going to shoot for 15 or 18. It's a time when the market doesn't have any headwinds. It's a time to work with more confidence and to shoot to generate a little bit or a lot more income. Because if the winds aren't necessarily at the market's back, they're certainly not in the market's face. And that's really the time to go for it. So thank you all for listening. Thanks for the questions. I have some things I have to do on EPD and SSYS. If you forgot to ask something, shoot an email through service@tradersreserve.com. And depending on the market, but probably, there should be 1 or 2 weeklies coming out tomorrow. And I'm not committing to anything. The market can change, but I'd like to do 2 more weeklies this week. Maybe one. And one. So there's a 50% chance of doing 2. And maybe another monthly this week. So keep an eye on your email. Thanks a lot.
Thank you, everyone. And the recording of this session will be available tomorrow morning. We'll send an email out to let you know when it's ready and when you can access it on the website. Thank you very much, and good night.